Welcome back to Bitcoin Season 2. I'm Charlie Spears, host of Bitcoin Season 2, which is produced by Blockspace Media. Bitcoin Season 2 showcases new ideas from new voices on Bitcoin. It's the technical and the cultural smashed together. New discussion on the oldest blockchain. Bitcoin Season 2 is produced by Blockspace Media. Make sure to check out our other content. The Gwart Show, I highly recommend. The Mining Pod, we have a newsletter that comes out on Mondays and Fridays. Make sure to hit our website and see all things Blockspace content. So today I'm talking with Leo Zhang, founder of Alkimiya. Leo's written some of the foundational pieces on the commoditization of Blockspace, and I'm glad to have him on the show. Welcome, Leo.
Thanks for having me.
Yeah. So we got to hang out a while in Hong Kong last month for Bitcoin Asia. It was a lot of fun. We got to go down some rabbit holes. But you've been building towards launch this company, Alkimiya. Can you just explain to me, talk me through the structure of Alkimiya? What is it? What's the vision? How does it work?
Certainly. Yeah, so I would describe Alkimiya as the market of all on-chain markets. So as Blockspace is where everything ultimately has to settle on, right? And it doesn't matter if it's a simple transfer or nowadays these kind of Mempool sniping activities getting more sophisticated, crazy RBFs. It doesn't matter how complex or simple these transactions are. Ultimately, all of them have to settle on chain. And all these surging demands, they compete for a finite amount of resources, which is the block space. And block space, in essence, is the amount of full node resources you're purchasing to run your transactions, to purchase settlement finality. And that requires payments, right? That requires cost, and this is something that affects every user who's using Bitcoin. And you wake up and you want to just do a very simple regular transfer, but some crazy runes collections happening. OKX is doing UTX, so consolidation, and there's a bug, and it has nothing to do with you, right? And you get hit with this impact. Your transaction all of a sudden becomes 5 times more expensive to be completed compared to just a couple hours ago. So this is a very unpleasant experience for regular users, for service providers who's conducting commerces on chain. So a thesis that we have is that, with Blockspace, it's kind of like the energy, right? It is the most fundamental commodity, most fundamental resource that powers the heartbeat of all public blockchains. And given the dynamic of supply and demand, the supply doesn't really scale, right? Like once every roughly 10 minutes, it doesn't scale that quickly based on the demand, but demand is very ephemeral. It can increase very, very quickly in a short amount of time. So that pricing of the access to this resource becomes a painful thing to every regular users who gets this negative externalities leaked on them, spilled over to them. So this has a lot of patterns, I guess, commonalities with how energies market, commodities market has developed over centuries. And in the past, this hasn't really become big enough of a problem because regular users, crypto and Bitcoin hasn't become mature enough to sustain this, to justify this kind of secondary behavior, right? People are just using, Bitcoin for fun, for very. It's a.
You could say degens. There are a lot of degens on Bitcoin right
now. Yeah. So we want to create a market where they can capitalize on this impact, right? They can trade transaction fees, so that for commerces, for regular users, they can offset some of their costs incurred on chain with the volatility of transaction fees too high. For miners, they can use this to capture some of the premium when transaction fee is being sold after. So that's the essence of. It's a very long-winded way of introducing Alkimiya, I guess.
Yeah, I mean, you say. You described Bitcoin's block space and Bitcoin's fee market kind of woke up this past year, so it's very well timed. I know you've been building towards Alkimiya for a while, and you're reaching mainnet. It's currently in testnet, but you float like this early client type of almost like the ordinals or runes trader as this near present like market participant who right now they need this type of product. What is like long term the commoditization of Bitcoin block space look like? Who are these clients? Who are the market participants like over the next maybe 5 to 10 years? Think long down the road.
Yeah, absolutely. I think if more commercial activities were to happen on chain, right, there would be more service providers. There would be more businesses that are built upon, that emerge on chain. And so for them, this become a very substantial cost of conducting business. They don't want this volatility. It's just similarly to, Con Edison, they don't pass the fluctuating electricity price all to their end users, right? So you locking a contract to turn on your AC, turn on your light bulb. It doesn't fluctuate with the rest of the globe's usage. And these companies, these utility companies are able to do that by, hedging on energy futures, beginning of the month, and lock in the average price for the next month or 3 months. So in 5 to 10 years, we expect this kind of behaviors to happen in crypto as well, where service providers, whether they're exchanges or sequencers for the rollups, or wallets providers, or platforms that offer collections, right? So these, if they want to offer a very pleasant fee experience to their end users, and not to mention if in the future we actually bring like social games, these kind of highly active kind of interactions on chain, these are costly. You don't want to pass that experience. You don't want to pass that volatility entirely to the end users. So the only way to do that is through this type of hedging instruments. So that I expect is to, I don't expect average users before they send a wallet transfer to hedge their transaction fee. I don't think that it's quite the case. Similarly to today, average users, I don't hedge my electricity price, right?
Yeah, you don't set up a synthetic electricity price contract every time you turn your light bulb on. You just expect it to be roughly X cents per kilowatt hour. So like right now, the current dynamic of Bitcoin's fee market is very interesting. It's really fun to look at because it feels like it's waking up. It operates in these like pulse events or like event-based fee spikes. Could you talk through this? I've talked a bit about this. I know you guys through your social media have described like almost like postmortems on like here's what happened in Bitcoin's fee market right now. Could you kind of just describe the current landscape of like these pulse-based events, maybe how Alkimiya fits into this model or can respond to these, how a user might like leverage that?
Yeah, I think waking up is the right word to use here, because these things, they have always been happening, right? They've been happening since Satoshi Nakamoto. It's just the kind of spiky behaviors, they're less pronounced. I mean, they were very pronounced for a period of time in the past. The congestions, this is not a new thing, right? We have experienced like congestions multiple times in history, but there was just no good way to deal with it other than, okay, I guess we have to scale the infrastructure, we have to scale the entire network now. And these things, they take efforts, right? And I think scaling is something that will always happen, and it always should happen. But scaling efforts, they require a long cycle of investment, long cycle of energy and efforts. So it doesn't quite necessarily solve the short-term fluctuations. And in fact, I don't think it will ever will. Short-term fluctuation is inherently a market-oriented issue. So I think the reason people start to think, we have more dynamic fee market now, one with having now that fee is much greater percentage of miners' revenue. Miners are much more sensitive to this. So miners are starting to think more about, okay, how do we capture fees more compared to in the past where they're just, sitting around because it's not really that big of a deal for them. Right? So now it's critical. It's continuing to become more critical. So that's why we see some of these out-of-band solutions, right? We see like more creative solutions of trying to capture that. I definitely think that Ordinals is it changed things. It changed the Bitcoin culture for better or worse. But it definitely changed how people. It definitely changed the composition of the mempool. It definitely changes the weight of transactions that people are doing, and you can definitely mempool is much more full compared to the past.
Yeah. Well, so, it's like one of the way I put is that previously you had just one type of transaction which users were using, creating, which is just like a normal financial transaction that wants to be included, have block inclusion in a certain window. But now we have like a wide range of transactions with different urgencies to them, or a person doesn't mind if their JPEG gets on Bitcoin today. They just want it to be on Bitcoin over the next month. So they have an entirely different like time profile. So it's really interesting to look at this.
Yeah, and this phenomenon has emerged, on ETH a long time ago, right? And we can talk about ETH here, right? Like this is not.
This is Bitcoin Season 2. It's on the table, yeah.
Yeah. Well, frankly speaking, we're going to deal with a lot of problems that other ecosystem, mostly ETH, have dealt with. So I think it's very, very important for us to look at, okay, what happened there, what kind of solution worked, what kind of solution is not quite working. So one thing I think people who are paying attention to this clearly feel, right, is that there are a lot more predatory activities happening on Mempool now. There's a lot more sniping, there's more RBF. I think that generally just creates like very negative externalities spilling over to regular users who are just doing their thing. But back to your point, right, what really triggered this is that now we have different tiers of transaction preferences for transaction, different time preferences for transactions. Some are much more urgent because the time value of those transactions, they loses over time. And if I don't capture this, it's gone, right? So I'm willing to pay much more, and as a result, the entire network had to suffer.
Yeah, and so I'm not like really myself familiar with conventional commodities markets outside of oil. I've not really studied derivatives. But I ask you about how you think about Alkimiya. Like, are you trying to model this after other like successful like commodities structures? Like, how do you look at what has worked in history and you just say, what does this look like in the modern blockchain era? Like, what are similarities between existing commodities markets and Alkimiya?
Yeah, I wouldn't say we're taking some orange trees playbook exactly here, because I think it's quite different, especially for this is inherently digitalized. This is inherently there's a production schedule, right, of Blockspace, comparing to I don't know, orange trees, right?
It's a great example.
Yeah, so it has some codified, not quite schedule, but patterns to it. And these are things that changes how inherently this market work, how the supply and demand mechanics work. And these are things that we can't really escape from. So when we think about, okay, how we're going to design this market, because this is really kind of a secondary market on top of the activities that's happening, on chain, like simultaneously. So when we think about that, we have to tailor a solution for Bitcoin. We have to tailor something that's like inherently, not too, like we can't just like put, oh, this is what worked for oil, this is definitely going to work for Bitcoin. In fact, we have tried multiple different solutions in the past and arrived at the current version, which, yeah, we're still experimenting.
Yeah, and so what's interesting, because I've only kind of recently started thinking about these concepts. You have different types of like the financialization and commoditization block space. You have like physically delivered block space, which would be the block inclusion, the transaction inclusion into blocks. And then you can create synthetics from that. And I haven't really fully thought through this question here, but what are your thoughts on like the differences between physical delivery and synthetic exposure? Like, what does this mean for users? What does this look like in the market?
Yeah, I think they're very different products. In fact, so even though this is actually a great example of how it differs from traditional commodity markets, right? So even physically delivered oil versus paper oil, there you're still trading on the price movement of thing, and of course there's wide range of logistics issues that's introduced that make them very, very different, makes one superior to the other. I think with Bitcoin, the so-called physically delivered block space is an entirely different product that caters to an entirely different type of users comparing to paper block space. So first of all, who would want to use physically delivered block space? What does it really mean is that I want my transaction to be included in the first 20 of a specific block height for some reason, right? So for some reason.
I want to get the next bitmap. That was my favorite example. Anyway, so yeah.
So but the reason is that there's some like very exogenous factors that have led me to want to purchase this. So this is more evident on Ethereum again with PBS, right? So builders for MEV searchers, they would want to sequence their transaction in a specific order so that they can maximize the value capture. But that is entirely exogenous to like it is a behavior that's introduced like externally. So the reason I wanted it is because I want to capture that external opportunity, right? So for that, it's a very, very specific thing. And it has very little to do with like, oh, I want to earn fee rate, right? Like I think that market activity is going to increase. That has very little to do with that. It has very little to do with like hedging out my transaction fee risk. It's more about I want to capture that opportunity. My transaction needs to be the first 20 of the block, 146,327 or something like that, right?
Yeah.
Whereas if you're just trading if you're trading fee rate, that's entirely different consideration. So if I'm wallets and I'm trying to compete with my competitors by offering a fixed withdrawal cost. Well, I think River, or if I remember correctly, recently announced something like that, like zero fee withdrawal per month.
Yeah, they integrate
something like that
or something. But yeah,
but if let's say I'm a service provider, I want to offer this kind of like superior experience to my users, but I inevitably have to bear some risk. So in order for me to feel good about bearing this risk, or like have some certainty on how much risk I'm bearing, I want to use these type of like financial instruments to hedge out my risk. So that's entirely a very different consideration because it sort of abstract out the whole the sequence of transactions in a block or block height. These things don't quite matter for the context of trading synthetics, because all I want is, if fee rate is going up, I'm taking a gain, right? That's.
Yeah, it's interesting. You brought up the example of wallets, and wallets may be competing on fee rate because they're customers of the end users. And I guess I was comparatively recently introduced to the idea of the transaction supply chain, which I guess is a familiar concept in ETH. And in a way, wallets, particularly retail-facing wallets, are a core part of the transaction supply chain. And a lot of wallet people that I talk to are like, maybe come to terms with the reality that what even is the wallet business? How do you make money off of it? Maybe your business model is that you're actually a transaction supplier. I know this may be the MetaMask model or some other. But I'm glad you brought up Blockspace markets on ETH and Solana. And I'm also glad you brought up PBS, proposer builder separation. I don't know if I feel that we have found a resolution whether that was good or not. What are your thoughts on this? And does Bitcoin experience something similar to PBS, or how do we mitigate some of the negative externalities from that? It's a very open question on that topic for you.
Yeah, I don't think the ETH community, specifically the researchers, have really arrived at a conclusion regarding PBS. Um, with PBS, a very clear direction that it's trending towards, and frankly, people have warned about for years, is that the builders are highly concentrated, and they're starting to verticalize, right? They're building their own relays. So there's just like a lot of efficiency you can achieve with centralization, with verticalization, with owning like different part of the stack. I think if we're want to be super precise with the technicalities, there is like kind of proposer and builder separation. The mining pool is the builder.
I say this. So like I feel like Bitcoin currently has PBS in a way.
Yeah, PBS was introduced like on Bitcoin first. Yeah. And we see this effect, right? There's tons of centralized. There's also centralization on mining pool level. So PBS had already happened on Bitcoin, and the builders have the equivalent of builder has already been centralized. And of course, the exact dynamics doesn't quite, and how the transaction flows from the searcher to builder to proposers doesn't quite work the same as on Bitcoin. But the analogy is not what we're trying to talk about here, right? But it's more on what is the long-term solution for Bitcoin to combat MEV, and how to prevent that from leaking to average users. Unfortunately, I think in absence of fast iteration, I think we're going to have to rely a lot on centralized service providers to try to provide a better experience on behalf of the users. There's really, I think, short term, that's the only way for them to do it, right? So like Magic Eden will. I don't remember if it's still the case, but I remember a while ago, due to and people their ordinals, their transactions couldn't go through because they get sniped left and right. So they offer some refund. Am I remember this correctly? Or?
I don't know about the terms of refund, but yeah, there's been people throwing stuff at the wall as far as mitigation or compensation. Yeah, it does. It tends to, like, sniping tends to plague the ecosystem when or the users whenever things are going up, because snipers snipe low, sell high. So
yeah, and there's really no good way to mitigate that, right? Like, and frankly, looking at some of the solution that like Ocean Protocol, like come on, like how is this real? Like, because it's 2024, and so it doesn't sound great, but I think short term, medium term, it is really up to centralized service providers to like how much of a better experience they want to offer their end users in order to stay competitive. Right? So if two equivalent services, one is offering some kind of compensation if their users' transaction get sniped, the other one doesn't. Right? And it's just like, all right, okay, I'm going with this one. So.
Yeah, and this actually gets into a piece you wrote a while ago. I forget when, but the piece "Things Hidden Since the Foundation of Blockspace," and you had a line in there which is something like, "MEV will keep growing in the future." I wrote it down. In the future, we expect the majority of Blockspace will be filled with MEV activities. Blockspace is a new kind of market, a market of constant action, of waves and fades, of tricks and ruses. We're now starting to see this more at scale on Bitcoin. It's more of the power user driven MEV and not as much the block producer MEV. What are your thoughts on, because you wrote this years before Ordinals and years before Mempool sniping was maybe commonplace. What are your thoughts on this now? Does MEV keep growing? Again, it's a broad category, but does toxic MEV increase? Yeah, what are your thoughts on this?
Yeah, I think this is I think MEV is inherent property of how public blockchain works. I think as long as there's mempool, there will always be MEV. And people love to complain about this from a philosophical level, but frankly, I think this is not strictly worse comparing to how Robinhood sells the transaction flow to Citadel, and they and you have nothing to do with it, right? Like,
unless you're trying to trade GameStop, it's a wonderful user experience.
It does provide a much better, user experience, but I think that's a slightly different thing. I mean, it is the same thing though. Like it does impact user experience. So it does impact, Bitcoin user experience. So like if you're just trying to do your thing and then fee rate just goes through the roof, and it's like, what? Like, okay, I'm just gonna send Venmo instead, right? So I think it's not something that can be just easily overlooked because like, oh, this is some degen shit, like it's gonna go away, it's gonna go out of fashion, and I'm on my high horse just looking at my maxi tech, right? It's not going to play out that way, right? And I think it's very obvious. I think it's very obvious given the kind of shit that we see on Mempool.
The Mempool, like one of the catchphrases that I've seen is like the Mempool is a bigger marketplace than Magic Eden, and it's kind of true. If you just think about the throughput of all of the activity and settlement through that, that is the ultimate final boss for just commoditization of this space. It kind of brings me to another question, which is, even though it feels like Bitcoin's fee market woke up this past year or so, if you still look at just the aggregate revenues of fees to Bitcoin, it's still like not a lot for a blockchain which is the oldest, 15 years out, where like the whole point is that this is supposed to, I would hope soon, transition to a fee-driven revenue towards miners. Like at some point, you would hope that fees actually gain a robust dynamic market to them. But I look at Ethereum still consistently like just dramatically generates way more fee revenue than Bitcoin. Is fee revenue the only way to value Blockspace, or are there other components to this? Because I feel intuitively that Bitcoin's Blockspace is more valuable, yet it does not generate as many fees as ETH. Do you agree with this? What are your thoughts on this? Like, why does Bitcoin's fee market still feel relatively immature?
I think so. For this question, I can give a marketing oriented.
Give me both answers.
And I can give a more thoughtful answer. I think so. I think the to the moon answer is that like Bitcoin has a lot of potential energy, right? Dormant capital. It's been there for years and just waiting for the right people to unlock, and it's there. Just look at the second best, right? Like look at that garbage is able to produce so much activities. We can do it too, right? And L2s are coming. Bitcoin season 2 is coming. It's going to unlock so much activities. Bitcoin Blockspace is going to generate so much revenue. It's going to happen. But I think the real answer here is that it's very difficult to compare apples to apples, right? It's not quite a direct comparison, because if we looking at it from a pure financial lens, it is how much I'm spending to produce a block from a miner's perspective, and how much revenue I'm capturing in that block in order to pay for my expense. So I think there's the reason this calculus is because it involves so many moving pieces, because my cost is entirely incurred in the real world. I have to pay physical infrastructure, I have to pay for electricity, power, labor to maintain the machines, I have to pay Bitmain, or I have to pay shipping, I have to pay custom. There's just a lot like physical dollar denominated cost that's very difficult to evaluate and evaluated over a longer period of time. Whereas for here, right, it's okay, the probability I'm able to capture the next block, or if FPPS slightly different, but the spirit of it is the same, and how much fee is being packaged into this block. What is the dollar cost of this fee? Like how long? What is my holding period of these Bitcoins? And now, looking at the composition of the revenue, we start to think, okay, how much of the fee comes from, Ordinals activities, how much of that comes from, runes and all these things. Are they sustainable? Are they going to become lower, higher? So I think comparing to something like ETH, where the fee market has been developed for a much longer period of time, it's really just the sheer amount of like activities, and that introduces volatilities, and it introduces competition for the block space, which I think we're just beginning to see on Bitcoin. So that's, a very fair thing, because fee rate is entirely generated by sort of the kinetic energy, right? Not the potential energy. Like Bitcoin can have a massive market cap. It can be the absolutely unchallenged, digital gold, and everyone should love it. But it's very different from the kinetic energy, which is, okay, I need to move it. I need to use it to do all these things, right? So that like scenario is we're just beginning to see, or waking up to it. I think for miners, this is starting to become less of a, a couple of years ago, a philosophical question of, security budget, is it enough to sustain? Now it is a real question. Miners should have vested interest to invest in things that produce more activities. So back to your amazing tweet that summarizes really well. Like, miners are investors of Ordinals, they just don't know it yet. In fact, I think miners' survival are, reliant on things that can keep producing activities. They want things to move. They want people to move this thing. Yeah.
Yeah. We pulled really far back. I want to tie it back in and wrap this up with back to Alkimiya and your current in testnet phase. You've been demoing some of this tooling. It's pretty cool. I'm looking forward to delivery on mainnet. Talk me through the current state of Alkimiya and maybe what the path towards mainnet launch looks like.
Yeah. So for those who are not familiar, you can check it out on alkimiya.io. The bazaar is live on testnet right now. So you can long, or you can take a long position or a short position on average transaction fee, average fee rate. So if you think that, okay, there's going to be another wave of runes activities that's going to push up the fees, if you are confident that, this is going to be huge, then a very obvious way for you to capture that profit is through longing fee rate, or that helps offset some of your cost of being degen. And if you think that it's overhyped and the fee decay is going to happen faster than people think, you can take the opposite side. If you're a miner, you can take the opposite side to lock in your fee revenue. So these interactions are all possible now. And the UI UX is far from perfect. We're making a lot of rapid improvements to it, and hopefully next time people look at it, it's going to be much better, and I'm confident it will be. So we are launching in July on mainnet, and I think around the time of Bitcoin Nashville, this will become more well known.
I think so too. Right now Bitcoin fees are down, but we know if you've been here the past year, that you can feel it almost brewing, just like another frenzied activity sometime. I don't know if it's runes driven or ordinals driven or some other degenerate speculative idea, but I look forward to getting totally liquidated on Alkimiya. I'm just kidding. I look forward to leveraging the product. I think it's really, really cool. It's about damn time we had options and ways to do this. In the 15th year of Bitcoin, we should have ways to hedge fees. So, yeah, anyway, any final thoughts, Leo?
Yeah, I think ultimately it comes down to, okay, more people are doing stuff with Bitcoin, right? And I think that's undisputed fact, and that's a good thing. That's what we wanted. So more people are doing things on Bitcoin. They're moving that inevitably leads to Bitcoin getting moved around, that creates more kinetic energy, that creates volatility to the fiat rate market, that affects everyone. So I think this is something that we want to create an experience where people are protected in some ways, or people are able to take advantage of it in some ways before this becomes, out of control. The fee rate itself on Bitcoin becomes out of control.
Yeah. All right, you heard it. Thank you so much, Leo. I look forward to having you back on Bitcoin Season 2 once the fee market gets really heated and we can do maybe some live triage on what it actually looks like and what it's doing. So maybe I would love to have that happen sooner rather than later, because it makes for more interesting content. Thank you so much for joining me.
Thank you. Thanks for having me.